In the heart of our digital age, a revolution is taking place. A revolution not marked by battle cries or the sound of marching feet, but by the silent hum of servers and the soft glow of computer screens. At the epicenter of this revolution, a digital currency emerges, challenging our very understanding of value, money, and investments. This digital currency is no other than Bitcoin. Born from the genius of an unknown creator, Bitcoin has risen from obscurity to become a global phenomenon. It's not just a currency, it's a technology, a culture, a statement, and for many, a beacon of hope for a future where financial control is taken back from centralized institutions and given to the people. This revolution is not just about change, it's about evolution, an evolution of our very concept of economic freedom and personal autonomy. This revolution is led by a digital currency known as Bitcoin. Today we delve into a fascinating aspect of this digital currency, the Bitcoin halving. This term may sound complex, but let's break it down into something more digestible. Imagine a gold mine where over time, the amount of gold you can extract becomes less and less. Bitcoin halving is a similar concept, but in the digital realm. Approximately every 4 years, or after 210,000 blocks have been mined, Bitcoin undergoes a process called halving. This process reduces by half the reward that miners receive for validating transactions and adding new blocks to the blockchain. Now, you may ask, why is this important? Well, let's consider the principle of supply and demand. When the reward for mining is halved, the rate at which new bitcoins are created and introduced into circulation is also halved. This effectively slows down the increase in Bitcoin supply. Think of it like a throttle controlling the speed at which new bitcoins hit the market. As fewer bitcoins are produced, their scarcity in the market increases, which can potentially drive the price up. This is similar to how the price of gold might rise if there were a sudden decrease in the rate of new gold being mined. Bitcoin halving is a built-in feature of Bitcoin's programming designed to control inflation and ensure the longevity of the currency. It's a testament to the foresight of Bitcoin's creator, Satoshi Nakamoto, who designed Bitcoin to mimic the supply rate of commodities like gold. This event of Bitcoin halving has occurred 3 times in the past, first in 2012, then in 2016, and most recently in 2020. Each time, the event sparked significant discussion and anticipation within the cryptocurrency community and often led to increased market activity. This event cuts the reward given to miners for validating transactions and adding new blocks to the blockchain by 50%. Understanding this concept is crucial for both seasoned investors and newcomers to the world of Bitcoin, as it plays a vital role in the currency's value and its future trajectory. Bitcoin uses a system called proof of work to validate transaction information. This is the engine that powers the Bitcoin network, a complex mechanism that is as ingenious as it is revolutionary. Let's break it down. When a Bitcoin transaction is made, it doesn't get processed right away. Instead, it joins a pool of other transactions waiting to be confirmed. Here's where the miners come in. These are the individuals or entities who use powerful computers to solve complex mathematical problems. Each problem solved confirms a block of transactions, which is then added to the Bitcoin blockchain, a public ledger of all Bitcoin transactions. For their efforts, miners are rewarded with a certain number of Bitcoins. This is how new Bitcoins are introduced into the system, a process mimicking gold mining, hence the term mining. But it's not as simple as solving more problems to earn more Bitcoins. The system is designed to maintain balance and stability, and this is where Bitcoin halving comes into play. Approximately every 4 years, or after 210,000 blocks have been added to the blockchain, a Bitcoin halving event occurs. The reward for mining is halved, effectively reducing the number of new Bitcoins entering the system. Imagine being a gold miner, and one day the amount of gold you get for your efforts is cut in half. That's exactly what happens during a Bitcoin halving event. It's a unique mechanism that's built into the Bitcoin protocol, a way to control the supply of Bitcoins and prevent inflation. This halving process continues until the maximum limit of 21 million Bitcoins is reached. At this point, no new Bitcoins will be created, and miners will be rewarded with transaction fees instead. So why does all of this matter? Well, it's simple economics. When supply decreases and demand remains the same or increases, prices tend to rise. That's why every Bitcoin halving event is closely watched by investors and enthusiasts around the world. However, during a halving, the number of new Bitcoins that are made gets cut in half. It's a fundamental part of Bitcoin's design, a rule that has shaped its past and will undoubtedly shape its future. Opening. The first Bitcoin halving occurred in 2012. As we delve deeper into the world of Bitcoin, we can't help but take a step back in time to understand how the concept of halving came to be and the impact it has had on this digital currency's journey. Bitcoin was introduced to the world in 2009 by an anonymous entity known as Satoshi Nakamoto. This digital currency was designed to have a maximum limit of 21 million coins, a cap intended to create scarcity and value. To control the rate of new Bitcoins entering the market, Nakamoto introduced the concept of halving. The first Bitcoin halving took place in November 2012. Prior to this, every 10 minutes, 50 new Bitcoins were being introduced into the system as a reward for miners who successfully added a new block to the blockchain. But with the first halving, this reward was slashed to 25 Bitcoins. This reduction was not merely a one-time event. On the contrary, it was designed to occur approximately every 4 years, or after every 210,000 blocks are mined. This ensures the continued controlled supply of Bitcoins until the cap of 21 million coins is reached. The second halving happened in July 2016, reducing the mining reward to 12.5 Bitcoins. The third halving in May 2020 brought it down further to 6.25 Bitcoins. Each halving event has been a pivotal moment in Bitcoin's history. They've been accompanied by significant price volatility and have sparked considerable debate and speculation among investors and enthusiasts. Yet, despite the uncertainties, these events have underscored Bitcoin's potential as a digital store of value. Closing. The next halving, expected to occur in April 2024, will see the reward fall to 3.125 Bitcoins. As we inch closer to this date, the crypto community waits with bated breath, curious to see how this event will shape Bitcoin's future trajectory in the digital currency landscape. Opening. The halving is significant because it reduces the rate at which new Bitcoins are created. As we continue to unravel the intricacies of Bitcoin, it's necessary to understand the implications of halving events. The halving process essentially cuts the rewards miners receive for their valuable work in half. This, in turn, slows down the rate at which new Bitcoins are added into the system. But why does this matter? Well, it all comes down to the fundamental economic principle of supply and demand. In the case of Bitcoin, the supply is not infinite. There will only ever be 21 million Bitcoins in existence, and over 18.5 million have already been mined. With each halving event, the rate of new Bitcoin creation slows down, making the remaining Bitcoins all the more valuable. This is because as the supply of Bitcoin decreases and assuming demand stays the same or increases, the price is likely to rise. Imagine, if you will, a world with only a limited number of gold mines. As the mines start to run out of gold, the remaining gold becomes more precious, driving up its price. Similarly, as fewer Bitcoins are produced, the existing ones gain value. Now let's take a look at the past. Historically, Bitcoin halvings have been followed by significant price increases. After the first halving in 2012, the price of Bitcoin rose dramatically over the following year. Similar trends were observed after the halvings in 2016 and 2020. However, it's essential to note that past performance does not guarantee future results. While the halving events have historically led to price increases, other factors such as regulatory changes, market sentiment, and technological advancements can also significantly influence Bitcoin's price. Closing. This inherent scarcity, combined with the historic increase in demand after previous halving events, fosters a sense of digital rarity that could lead to potential upward pressure on prices. As we approach the next halving event, it's worth keeping an eye on the market dynamics. Will history repeat itself, or will we witness a new chapter in the Bitcoin narrative? Only time will tell. Until then, let's continue to explore the fascinating world of cryptocurrency. As we approach the next Bitcoin halving, investors and enthusiasts alike watch with anticipation. This event, a cornerstone in the chronicle of Bitcoin, brings with it the promise of change, the potential for growth, and a renewed focus on the core principles that make Bitcoin a revolutionary force in the world of digital currency. The halving is a testament to the ingenuity of Bitcoin's design, a built-in mechanism that helps maintain its scarcity and value. It's a fascinating process that not only impacts the miners who validate transactions, but also the broader cryptocurrency market and all who participate in it. As we stand on the precipice of this event, it's important to remember the journey that brought us here and the potential path that lies ahead. With each halving, Bitcoin continues to evolve, to adapt, and to prove its resilience in an ever-changing digital landscape, ready to witness the next chapter in the story of this groundbreaking digital currency.